if somebody tells me, oh, the world is going nuts over gold right now, and the economic situation is going to get worse, we're going into recession, but the gold price is going down, I'm looking at that person going, what do you know that we don't that's different than the last 5,000 years of track record? You tell me what's different. Did people go to Bitcoin last year? No, they got out of Bitcoin. It wasn't the where people went to safety. And they didn't go to bonds because the bond rates rose. And they're not going to the dollar because the dollar is crashing and the rest of the world's de-dollarizing. Where are you going to go? You're going to go to the precious metals.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Robert Kientz from GoldSilverPros. Robert, thank you so much for joining us today.
Thanks for having me on, Elijah.
Well, it's great to have you. Quite an exciting weekend here. Obviously, this happened over the weekend, where now this is the second largest bank to collapse in the U.S., First Republic. The FDIC was frantically working over the weekend with other banks trying to get bids for First Republic's assets. JPMorgan came to the table, I guess, bought pretty much most of First Republic there. But the FDIC is still estimated to have a cost of about $13 billion for this taken into receivership / JPMorgan buyout. Your perspective, what we saw over the weekend here.
Yeah, it really is just a continuation of what we saw a couple of months ago. The problems in the Treasury market are causing problems with the banks because they're affecting their balance sheets, as well as adding to that post the Silvergate, SVB failures and Signature Bank. People began taking money out. They began taking deposits out. And this came up in the last couple of weeks when I was looking at Fed charts from the Fed. And I was looking at deposits going, wait a minute, these are being drained. People are pulling their money out, and they kept pulling it out even after the government stepped in to save, SVP and Signature, or at least bail out depositors and really save the bank. But they bailed out the depositors. And so everybody, I think, kind of felt like everything was okay. The stock market started climbing again. You still had some challenges in the bond market, but rates were coming down. It looked like the economy had priced things back into where we were back to some level of normal. And then, of course, First Republic had issues and then comes back and needs to be bailed out, essentially. According to the news, JPMorgan, was the highest bidder on it, much like they were on the largest bank failure during the last crisis, Washington Mutual. So JPMorgan has been the backstop for the two largest bank failures in U.S. history. I believe First Republic had $233 billion in assets, larger than Silicon Valley Bank when it went under. I think it was something like $208 billion. So now First Republic is the second largest bank failure in the U.S. history. They had, I believe, 84 branches in 8 states, sizable deposits and things, and JPMorgan bought a lot of it. I think the FDIC was out about $13 billion or so from the deal, and I think there are some assets that JPMorgan won't take. But for the most part, JPMorgan's buying up the bank. And essentially what you see happening as the Treasury market begins to collapse down as people lose faith and those rates are rising. As we go towards recession, you have raising rates, and that's going to cause a downward spiral in the Treasury market because rates are going to rise. People are going to want to dump Treasuries, especially banks, family offices, companies, to pay off debt and pay expenses. The economy's not doing well. And that's going to cause issues with the banking system. And I don't think the problems are over just yet. And as we go through each bank failure, regardless of what the Fed says, regardless of what JPMorgan says, regardless of the reassurances that the administration and the media are trying to give people are still taking their money out. So I don't see this ending for that reason. If I hadn't seen, Elijah, all that deposit money come out of the U.S. banking system and continue to come out, where we've had the largest withdrawals basically in history since these bank failures, I wouldn't be quite as, I would still be concerned because the banking system's not in good shape, but I would think that maybe we would have some room to maneuver. Now, I think with First Republic, even with Jamie Dimon coming out and saying this is not a big deal, we got it covered, I don't know how he knows that because Jamie Dimon may be the head of the largest American bank, but he doesn't know the balance sheets of all the other banks. Not only that, JPMorgan can't backstop all those banks, and neither can the FDIC. Nobody can backstop the entire banking system. So I think a lot of the rhetoric coming out this weekend was to calm depositors and investors, which we need. The last thing we need right now is a bank run. However, people are going to do what's right for them. They're going to pull their money out. And with the gold and silver sales that we've seen recently, I think a lot of that's going into gold and silver. You can see it in the sales and some big sales coming down the pike. We've been contacting some rather large sales as well. So you're starting to see people getting interested in gold. And I think, behind the scenes, people are taking the money out of banks. They're going to safety. They're going to precious metals, despite what the government and the Fed are saying.
Now, if you do look at the Federal Reserve data there at Fred, you do see about $500 billion over the last 2 months were taken out. Bank deposits shrunk by that much. Do you see this to continue, or what are the ramifications here?
Yeah, I think what we're seeing, honestly, is a modern day banking run, because in the old days, you would show up to the bank and take your money out, like that scene in It's a Wonderful Life, where they have the little bank run and people go, and as long as they have enough cash at the end of the day to close their doors, they don't close. Well, now people bank on their phone, and they bank on computers and they bank electronically. And so a lot of the capital flight from the banks has been that way. So you're not necessarily seeing lines of the bank. So you're not seeing physical signs that are going to warn people that there's a bank run, because of the electronic nature and the cashless nature that a lot of our society is in right now. And so a lot of that money is coming out, and my friends are either buying precious metals. I had a friend come to me, and he's been following me for a long time, and we worked together for a long time ago as auditors, and I've known him for about 15 years. And he came to me last week and he said, I'm ready. I'm going to move my 401k, my IRA, everything out and put it in precious metals. And he just took the plunge. And I'm seeing more and more people doing that. And more people are either not participating in their 401k or they're taking money out of the banking system. Now, the repercussions of that are, when you take deposits out of the banking system, remember, this is fractional reserve. It's actually more than that now, but typically about 9 times the amount of money goes out in lending for new loans, and only about 1/10 or so stays in the bank as liquidity requirements. Now, if you get into the fine details, it's actually less than that, because they've changed the rules on things like money markets and CDs. But in any case, that's the general rule. Well, when you lose liquidity in the bank, what do you have backstopping all those funds in case you have loan losses? And what happens during recession? Loan losses go up. So as we look at the banks, their assets are being cut down in value by higher interest rates, which lowers the value of the bonds. And what do banks invest in? They invest in bonds and paper and things like that, stock market, riskier investments over the longer term. And what happens is, when those go down, their balance sheets get sideways. Depositors know that, they pull their money out. Then all of a sudden, the banks are in a tough position. They don't have enough liquidity to deal with their existing loan base. They can't loan more out because it creates more risk. It makes them even more lopsided. They need liquidity. That's why when First Republic and Silicon Valley Bank got in trouble, and even Credit Suisse, the national banks were guaranteeing giving $30 billion and $50 billion, because they knew that bank was going to collapse unless they got an immediate injection of liquidity to make up for the depositors. So what's happening? The depositors are pulling their money out and putting them in other assets. The central banks around the world are sending and printing more money. All that is hyperinflationary. So it just adds to the screwed upness of the situation, to the point where, we're just making it worse at this point. And again, all the reassurances by the government are nice to prevent the bank run, but they're not solving the core of the issue. The core of the issue is treasuries aren't doing well. It's affecting balance sheets. People are pulling their money out, and simply papering over that is only going to give a false sense of security to people, and it's going to make the situation worse later on.
Now, the interesting thing about this is that there's a difference. So in 2008, you saw a lot of issues with mortgages, obviously, mortgages that shouldn't have been, money that shouldn't have been lent there. The issue right now with the Treasury is that the banks have to hold these to maturity if they're not going to take losses. So it seems like a slightly different issue here, but still pretty serious if you do see this bank run, which we're seeing right now, people taking money out of the banks, because if the bank has to sell these treasuries, they're at a loss. So do you see, some people are saying that, these particular issues were isolated to just these number of banks here. But do you see that this is more an issue across the banking system and we could see further failures coming?
Yeah, because the causes of these bank failures will be the causes of other bank failures. In other words, all banks pretty much do the same thing. If you look at how banks capitalize and you look at things either like BIS liquidity requirements or even, nation state or state liquidity requirements for banks in different jurisdictions, there's a certain amount of liquidity required. But also their assets have to be of a certain type. And the banking system's built on debt. Not only do the banks issue debt, they have the debt as assets, and debt is not an asset. This is the biggest lie that's ever been told in finance, that debt is an asset. People call debt an asset because they're looking at the return of cash flows. They're looking at return on money. And like, hey, if I loan out $1 million and I get 10% back, it's $100,000. Great. I'm not worried about my principal. Now we've got principal risk. The principal is going down because of what's happening. And the entire system had not planned on that. The entire system was built on the fact that we always were going to have an expanding credit cycle, that debt was an asset, that we would never have problems paying back that debt, and that we could guarantee ourselves high rates of return. Why? Because you just issue more debt, which spurs more investment, which gets you your return. It's a Ponzi system. And the Ponzi system worked up until it doesn't. And ask Bernie Madoff and his investors how that went. Ask Charles Ponzi how his investors, how that went. It goes well until it doesn't. And that Ponzi system, is going to come down. And if you look further into the company, I'm bring another point up, not to confuse things, but just to show that it's not just the banks. It's being reported now that so far in 2023, there have been 70 major bankruptcies in corporate America. It's not just the banks. The biggest one is Bed Bath & Beyond. Who thought that a stalwart, something that, every wife in America visited every weekend along with Costco, you go to Bed Bath & Beyond. If you're a guy, your wife takes you to Costco and Bed Bath & Beyond. That's where you live on the weekends. They're going out. David's Bridal is going out. Why? Because people aren't getting married. You have that demographic issue. Boxed, Independent Pet Partners, Tuesday Morning. That's a discount. Tuesday Morning is a discount retail good. If the discount stores are going out of business, what's next? Dollar General? We're talking about issues in the economy. We're not in an expanding economy. We don't have expanding bank deposits. We don't have expanding bank loans. We don't have expanding spend by consumers who are tapped out. It cannot grow. And when it cannot grow, it's got to shrink. And when it shrinks, what happens? That debt collapses. We're seeing the collapse of this iteration of the debt cycle, and it can't be stopped. Because unless you can get people to buy more, and unless you can come up with real organic growth, producing real organic societal goods, papering over with money that people are de-dollarizing out of around the world, is not going to work. If the United States was still considered the world's reserve currency, not only in name, but in fact, where everybody was actually using it for things like trade and oil, and the BRICS nations hadn't developed their own, then I would say, okay, we could get through this crisis in a normal cycle. We could deleverage, we could go through that pain, and we could come out on the other side okay. But you look at de-dollarization around the world, nobody's going to save the dollar this time. There's no one going to save it. The Fed is on its own. It is not only the lender of last resort, it's the only freaking lender we have. And either the Fed gets sacrificed or the economy gets sacrificed, one or the other. And that's going to be interesting to see what happens. I don't think anybody wants the currency to go away. I don't think anybody wants that. So I think they're going to try to save the currency, and they're going to let, the regional banks start to crash. And what's going to happen is you're going to see the regional banks bought out by the bigger banks, and you're going to have consolidation, and the big banks are going to get bigger. And that's what happens every economic cycle.
And it is, we're seeing this right now, JPMorgan being the biggest bank in the US, taking over First Republic. So JPMorgan just expands and becomes bigger. So you're saying that we're just going to continue to see the big banks get bigger and the regional banks disappear. What does that do to the average person? Because it seems like more competition is a good thing. Regional banks, having local banks is a great thing. Having that local, relationship with your bank is very good. But it seems like we're going to see that start to disappear.
Yeah, personally, I've used banks and credit unions. I have credit unions now for my business and personal accounts because they just have better service. They have better rates. For me, I'm more comfortable with that. They tend to not have as many balance sheet, although the credit unions will get affected by the current issues. But they seem to be a little bit in better fiscal shape, and they get better customer service. Now, the drawback is when you own a business, sometimes it's easier to have a bank because when you travel and things like that, it just makes it easier. So a lot of people are keeping their money in these regional banks. And when they collapse, it's going to take a lot of business with it. And that's why I tied it to the bankruptcies that we've had, because if people lose their operating cash account in businesses because of bank failures, those businesses could freeze and go under, and you could see that contagion start to spread. And that's what happens when you see a collapsing economy like this. It's not the thing. The Fed can step into the banks all at once. Like I said, it's inflationary in the long run because all you're doing is papering over more money. You're extending the Ponzi. But what's not being talked about is the rot underneath the entire American economic system. And if these companies can't get access to their bank accounts, and the consumer's not showing up buying goods and they have no liquidity, they're going out. So what's going to happen, a lot of businesses are going to go under. And by the way, that's going to come back and affect the banks. Why? Because the banks gave them the loans. So it's this nasty, incestuous connection, this spider web of all these entities in the economy where you can't play whack-a-mole. You can't, hit this mole and solve the problem, because the problem is endemic across the economy. And again, it starts with the currency. And until we get rid of this iteration of the dollar and come up with something better, these are the types of issues you're periodically going to have. That's just the problem with fiat currencies, and it affects everything. So no, I don't think it's going to stop. I do think the contagion will get worse. I think that people have positioned themselves in precious metals and paid off debt and done things like that will probably do better than others. But also, if you're a business out there, you have to be worried about your operating bank account and whether or not you're going to have liquidity that you need. And I think that's, Elijah, tying it back to deposits. That's why we're seeing deposits come out. It's not just the average person, it's businesses pulling money out. And that's something I've had to do. I had to pull a little bit of money out just to be on the safe side, so I had operating cash. And so even a bunch of small businesses just pulling a little bit of money out also affects the solvency of the system. When we get people pulling out their entire accounts, then we're in big trouble.
As this is impacting the precious metal markets, over the last month and a half, 2 months, we've seen incredible demand for physical precious metals. What have we also been seeing on the large exchanges, the COMEX and the LBMA?
So in the April 4th COT report from the CFTC, I looked at gold and I saw the bullion banks put in 24,000, I think it's 24,596, I remember. Numbers could be wrong. But it's almost 25,000 short contracts on gold at one time. That was 10% of their entire short position on gold they did in 1 week. And they've maintained it. They're now short over 274,000 contracts. And they kind of rolled out of a little bit of them last week. They deleverage out of shorts, about 5,500 contracts, but they're still 3-to-1 almost short in gold. So obviously they're betting short gold. Now, given the issues in the economy, it's obviously, I don't think that gold's going to go down. And if you look at the way the big banks trade it, they trade it based on where they're positioned in the markets. In other words, the spot price of gold really doesn't have a lot to do with physical. We've talked about this. It has to do with speculative trading. And the bullion banks right now are betting that gold is not going to stay up. They're going to lose that bet if we continue to have bank failures, because Bitcoin, the cryptos they're not serving as a safe haven. The stock market is very volatile and tumultuous, which I said would happen at the beginning of this year. Once we got into this type of thing, big economic issues, you're going to see volatility. And you're seeing people position in the metals markets, and I don't think those positions are beneficial. They do offer some ability to get in here, gold under its all-time high. But eventually, the bullion banks are going to have to unwind these positions. Gold's not going down long-term from here. There is no way. I think the short positions were a vote of confidence. If you think about JPMorgan's one of these bullion banks. It just bought First Republic. So it's sort of a vote of confidence of prop up the banks, maintain the gold price. That's the strategy, right? That's falling apart because despite Elijah, 1/10 of their entire short position being placed in 1 week, a massive bazooka blast of short paper, gold's still rising and it's still challenging 2,000 all over again. You can't keep gold down with paper when people want it. And the paper trade's going to start to break down here. Now, they still have some effect on it because the big bullion banks have the largest single positions, and they're market makers. They can move it to certain targets and make money. So if it's going up or down, they're going to make money. But when you get that big blast of gold, when people come in and they really want that gold, the bullion banks are going to be on the wrong side. And I don't think the bullion banks are stupid. So while they're taking advantage of their position right now and also trying to help the government, I think the government probably asked them, hey, keep the gold market down until we can figure out the banking system, because the gold market it's like the bat signal. When the gold market gets fired up, everybody comes for gold. Case in point, last week, and I cannot give details because we're still in play on this, but I had a serious group of investors backed by serious money looking for over 100 million in gold, and they wanted it in a combination of doré and bars. And doré is pre-final step of refining when it's not completely pure, and there's a little bit of uptake on that because purifying and selling, you get a little bit of money, and that's what they want, but they also want fresh gold. So this is the second point of why that was a big deal. And they haven't expressed this to me, but I happen to know this is one of the benefits from studying the market. When you get gold doré from a miner and you put it through a refinery, you have first claim on that gold. No one else can claim it. You have the original certificate of title, if you will. And as long as you maintain that and you maintain your chain of title and you can prove it, nobody else has a claim to that gold. And so if you're an investor and you're going to bid up over $100 million on gold, are you going to want to go to gold off the exchange that could be rehypothecated to 10 other people? Maybe that gold's been pledged a bunch of different places. We don't know. And so part of the request for that type of gold is to make sure you have the original claim and that there won't be any legalities around that. Because when the music stops, Elijah, there's not going to be enough gold, and lawsuits are going to fly, and people are going to put claims on gold that may not be theirs. They may be frivolous, but real lawsuits in which two people believe they own the same bar. And oh darn, that bar got bid out on one market and bid out on another. Oh, shucky doodles, that you're going to be in that legal fight. And the time that you need gold to capitalize your business, or to secure your financial position, if somebody else has a claim on it, guess what? It's tied up in court. You can't use it. And so we're seeing those big orders come in. I also had a group come to me and say, is there any way to get that artisanal mining? And they were thinking about starting like an ETF to get funds in to then support the artisanal miners. But I'm thinking artisanal mining is small mining done maybe thousands and tens of thousands of times over. And there's a market for that. Guess what? It's in Dubai. So why don't you just go to Dubai and buy it? But they're trying to get in front of that UAE market and get that gold. Why? What that tells me, when big people come in and they're trying to get it before that gold pops out in its finished form on these exchanges, it means that these exchanges are not providing that big liquidity that we think or we thought that they have. Because if they did, why don't they just go buy it off the exchange? I've got an offer right now. Somebody wants to sell me 200,000 kilograms of silver, and they're offering 10% less than LME spot price. Fabulous. It's a great deal. You can find those buys sometimes on the finished product, but that's the only one I've been able to find in size. I can't find it in gold, and that's the only silver one I've been able to find. So there isn't a lot out there in bulk that people are wanting to let go. And so what you're seeing is people positioning themselves earlier in the supply chain to get it. And I reached out to no less than 20 miners last week trying to see if I could fill that order. And they're like, we're going to the refiner because it preserves their profit. But the refiners have locked that in. Why do the refiners lock it in? Why does, I talked with a CFO of a silver company that I've covered for many years down in Mexico. And he said, I've got 3 manufacturers that have a bid on our silver, Samsung and 2 others. Their silver's long gone. And Samsung is even porting it to the refinery themselves. The big corporates that need a lot of this gold and silver are front running. And the hedge group fund that came in is just big money. It's independent, wealthy people. And now they're coming. So big money's coming in before that gold gets found in manufacturing. They're trying to take it off. That tells you there's not enough coming out of the exchanges. And I don't care what they say on the exchanges about their liquidity. We would not be having these big orders come through if they had it. I think it's a sign, Elijah, that liquidity on the big exchanges is a little tight right now. And big money's coming in, looking at these bank failures going, we need to get into gold. They're not, buying all the Bitcoin, they're buying gold. And that really tells you what people want, how they want it, and why they want it. And these are clues as to how this market is manifesting.
That is interesting. I think it's a very key there that they're not looking to the exchanges at this point. We're also seeing a lot of central bank demand that we've talked about in the past. I know UBS put out a report that they think central bank demand is going to continue to be high and gold is going to make new highs. Your perspective on demand coming from central banks themselves?
Yeah, the central banks in 2022, according to the World Gold Council and Metals Focus, which tracked this, bought more gold than they have in their history. 2022, the central banks bought more gold than they ever have in history. They've been buying it since the last crisis, about 2010, 2011. And last year they bought a bunch. Why? Well, you have the Basel requirements, which emphasize gold as a high quality liquid asset. You also see people looking at U.S. Treasury debt going, oh, wait a minute, that's not holding up so hot. Maybe that's not our main safe haven. Maybe we need to deleverage. So I think people are coming to the gold markets to get it. And as they're getting gold, they're selling some of these treasuries and things, but nobody's trying to set off the alarm. Nobody wants to dump $1 trillion in U.S. Treasuries and crash that market. First of all, they don't want to crash their own assets. And second, they don't want to let people know. And so they're deleveraging out of this stuff, which is why bond rates are rising. And you have gold prices rising because the demand is going up to where you can't hide it anymore. People are rotating out. And so, yeah, I think gold demand is going to be very high. I think bond demand is going to come down. And that's really what we're seeing in the economy.
For those, I guess, who are looking to get into precious metals, how we've talked about before, and I know Andy Schectman has talked about this before, that there's really no price on insurance. So if you don't have any, it doesn't really matter what the price is. But those looking to add to their position, what is your forecast on the metals? It seems like you don't see them going down that much from here. And obviously we can't give financial advice, but your opinion on this?
Yeah, I can't give financial advice. Please, everybody, consult their own financial advisor, do your own research. But that being said, yeah, the metals are always going to fluctuate. It's the futures market. If somebody wants to bet short and dump a bunch of paper, they can do it. And when that happened on that April 4th week, it did prevent the gold price from reaching its all-time high. Did it stop it? No. Did it drop to 1,700? No. Now, if you drop 10% of your entire position at one time and it doesn't drop gold down significantly and it holds serve and all you've done is prevented it from reaching a new all-time high, that tells me the market is more robust than anybody that wants to short it. So I don't see it being down for an extended period of time. Now, if we have no more bank failures and everybody gets kind of comfortable with the bailout of First Republic, then we could be okay for a little bit and we could sideways trade. But all it takes, Elijah, is that next bit of news, and man, that thing's going to launch. And with gold being near its all-time high, there's no resistance point on the technical chart to stop it. And once silver gets to 30, there's not a lot of resistance points there. So we're at that period of time everybody's been talking about where you're sitting near the all-time high in gold. Silver's edged up saying, okay, gold, you're big brother. You haven't really launched. So I'm just going to sit here a little frothy, but I'm the little yippy dog and I'm waiting for the big dog to tell me what to do. The big dog is gold. That big dog gold is just sitting there looking at that economy and it's saying the next time something happens, I'm going to bark and I'm going to bark and I'm going to bark. Okay. And then eventually it's going to bite. And when it bites is when you have the run. And I think we're getting close to that. Honestly, I just don't see what's going to crash the gold market. Even if they drop another 24,000 contracts and it drops it, 50, $100 or whatever, people are going to come in anyway. You're not going to stop it. When you have people that are not ordinarily gold investors buying 100 million plus at a time, okay, this isn't gold bugs. This is generalist demand. And it's not generalist demand, Elijah, going into SLV and GLD. It's generalist demand going to physical. What did we say during Silver Squeeze 2 years ago? You better get your physical. Because people bought SLV and they realized they couldn't get it out. And we said that. And then they went physical to PSLV and physical sales have been booming. The COMEX has been drained for 2 straight years. London's been drained for 2 straight years. We're having ridiculous amounts of delivery, 70 to 80% of gold and silver on Shanghai. Ridiculous. I mean, people are getting it wherever they can. If somebody tells me, oh, the world is going nuts over gold right now, and the economic situation is going to get worse, we're going into recession, but the gold price is going down, I'm looking at that person going, what do you know that we don't that's different than the last 5,000 years of track record? You tell me what's different. Did people go to Bitcoin last year? No, they got out of Bitcoin. It wasn't the where people went to safety. And they didn't go to bonds because the bond rates rose. And they're not going to the dollar because the dollar is crashing and the rest of the world's de-dollarizing. Where are you going to go? You're going to go to the precious metals. Could it go down? Sure. Do I think it's going to go down in the near future? No, it's not. It's going to go up because people want it and because the banks are going to use it to recapitalize. And when the digital currencies come out, they're going to need something familiar for people. If the fiat currencies are crashing, they need something to hold up to people and say, this is what is going to get us to the next stage. And they want the central bank digital currency. So they're going to have to use gold along the way. So for all those reasons, do I see it falling down for extended period of time? No, I think we're at that point in which it's going to go. And when it goes, it'll even get to a blow off and get in a bubble. And we'll talk about it when it gets into a bubble. We're not there yet, but gold will go in a bubble and it's going to shock people. People that have said this is a barbarous relic, we're moving on to digital currency era, gold no longer has a place, I think are shocked right now. But they're buying it. They're buying it. They're not buying the Bitcoin, right? So yeah, I think gold has already signaled its importance. I think people understand. People that even aren't gold bugs are jumping in, and you see where people are going. And you just read the tea leaves. It's right out there in front. And if you follow it, you know. And if you know, you can prepare. And if you prepare, you're going to be okay, I think.
All right. Well, Robert Kientz, we really appreciate your time today. Before we let you go, where can our viewers find you online if they're interested in learning more? And what are your last thoughts for our viewers?
So I would say just find us on GoldSilverPros.com, all social media, YouTube and Twitter. But I would say stay right here at this channel. Don't leave this channel. This is a great channel. Always recommend people come to Liberty and Finance. Not only do you cover the financial side, but you cover all the other prep things that people need. And in addition, your dad covers spiritual, health, all those things that people are going to need to get through rough economic times. It's not just preparing with gold. It's preparing yourself internally, having good relationships, being right-minded, being fit, having skills, things like that. All of these things are what we need to go to when we go through these economic downturns. We rely on all of it, and your channel does a great job of that. So I'd say people just stay here, honestly, and follow along. And I'll come on your channel every once in a while if they want to see me. But you guys have such great content, so just stay right here at Liberty and Finance.
Fantastic. Robert, thank you so much for your time today. We'll put links to your content in the description of this video here. Thank you once again for your time, and God bless.
Thank you, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.